The government budget serves as a crucial blueprint for managing a nation's finances. It details how public funds are allocated and spent, reflecting the government's priorities and policy objectives. By outlining expected revenues and planned expenditures, the budget helps maintain economic stability and ensures that resources are used efficiently. Its significance extends beyond financial planning as it influences social programs, infrastructure development, and the overall well-being of citizens. Understanding the government budget is essential for appreciating how fiscal decisions impact everyday life. The revenue budget forms a crucial part of a government's overall financial plan, outlining its expected income and routine expenses for a given fiscal year. It is divided into two main components: revenue receipts and revenue expenditures. Revenue receipts include all income generated by the government through taxes and non-tax sources, such as interest and dividends. In contrast, revenue expenditures refer to the costs incurred for the day-to-day functioning of government departments and services, excluding any capital investments. Understanding this distinction helps clarify how the government manages its operational finances and maintains fiscal discipline. Revenue receipts are funds that the government receives through its regular operations, and they are primarily categorized into tax and non-tax sources. Tax revenue includes collections from income tax, corporate tax, excise duties, and customs, which form a significant portion of government income. Non-tax revenue, on the other hand, comprises earnings from sources such as interest on loans, dividends from public sector enterprises, and fees for services. Importantly, revenue receipts do not create any new liabilities for the government, nor do they lead to a reduction in its assets. They represent income that supports the government's routine expenditures and helps maintain fiscal stability. Revenue expenditures refer to the routine expenses incurred by the government in the course of its daily operations. These payments are used to fund activities such as salaries for public employees, maintenance of infrastructure, and provision of essential services. Unlike capital expenditures, revenue expenditures do not result in the creation of new assets or the reduction of existing liabilities. Instead, they are necessary for maintaining the ongoing functions and responsibilities of government departments. Such expenditures ensure the smooth delivery of public services and the effective administration of government policies. The capital budget is a crucial component of government financial planning, focusing on expenditures that lead to the creation of long-term assets. This includes investments in infrastructure, buildings, and equipment, which contribute to the nation's economic development. The budget also tracks changes in government liabilities, such as loans and repayments, ensuring that borrowing is managed responsibly. By distinguishing between capital and revenue spending, the capital budget helps policymakers allocate resources efficiently and maintain fiscal stability. Its role is essential in shaping the future capacity and financial health of the government. Capital receipts refer to funds that a government or organization receives from sources such as borrowing or the sale of assets. These are typically non-recurring and do not arise from regular business operations. On the other hand, capital expenditures involve spending on acquiring or improving physical and financial assets, like infrastructure projects or investments in securities. The distinction is important because capital receipts, such as loans or proceeds from asset sales, increase liabilities or reduce assets, while capital expenditures create long-term value. Understanding this relationship helps in evaluating the financial health and investment strategies of an entity.